Welcome to everybody for attending today's webinar. Thank you all for doing that. Just to let you know, there's quite a lot of information in this presentation, so I don't intend to read every single word, but just to give you an overview. The last thing I want is death by PowerPoint, because I've had to personally suffer from that many times. Just to reassure you, you will be sent copies of the slides after the webinar. So, with no further ado, here's the first slide. Private sector final salary pensions. There are some new rules coming in, being imposed by the FCA from the 1st of October. New rules that will affect advisors advising on final salary pension schemes, but indirectly it will affect the ex-members of such schemes, private sector final salary pension schemes. This is for people who haven't yet started taking benefits out of their pensions. Because the rules will be pretty onerous on advisors, it's anticipated that there'll be a lot less advice being given to individuals, which indirectly will mean that a lot less final salary pension transfers will happen in future. But once you've been through his presentation, you may decide, if you're in this category of people, that it could be a good time to have your pension reviewed, at least. Anyway, this is about as much fun as it gets, this presentation. Are final salary pension schemes sacrosanct or not? It does appear to me, this is quite a good example, that final salary pensions are being treated as though they're so precious you mustn't ever touch them, but it's not. Life's never quite as simple as that. I think most people would agree. So what is a final salary pension scheme? Well, it's basically a guaranteed pension based on a formula. Now, without going into great details, I thought I'd just use a very simple example on this slide. One based on someone who's had 30 years service, in other words, been a member of a pension scheme, final salary pension scheme for 30 years, had a salary in the final year of £40,000, and the scheme also offered something known as a 60th accrual rate, which is probably a mystery to most people, but let me explain how that works. So if the accrual rate is 60, if you work for 30 years, you'll see in the third line down there, 30 divided by 60, the accrual rate, multiplied by £40,000, the final salary, final year's worth of salary, gives you a pension of £20,000 a year. So that's so good, so far so good. But usually most people would take a tax-free lump sum and a reduced pension. Now there are limits with each scheme what the lump sum may be. For some schemes it might be 2 times, some 3, some 4 times. It could vary from that. There might be a fixed amount you're offered as a tax-free lump sum, but come what may, if you get a tax-free lump sum, usually it means a reduction in the pension plus a tax-free lump sum. So just as an example here, I use one where someone achieved a tax-free lump sum of £50,000, and to get to that figure, each scheme has what's called a commutation factor. In this simple example, the commutation factor is 10 to 1. So for every £1 a year of pension given up, £10 of tax-free lump sum is given 10 to 1. So £5,000 pension given up, multiplied by 10, gives you £50,000 tax-free. As a consequence, the £20,000 a year pension is reduced by £5,000, the pension given up. And as a result, the pension is reduced to £15,000 a year, plus the tax-free lump sum of £20,000. Alternatively, this person could have just taken a pension of £20,000 a year. So what's a money purchase pension scheme by contrast? Well, unlike a final salary pension scheme or defined benefit scheme, a personal pension or not a personal pension, a money purchase pension scheme, most well-known one of which is personal pensions, or it might be company money purchase pensions, but they all look and feel and breathe and appear to be the same. They're really just an investment. The majority of the money is invested into shares, but most advisors like us would use a system to manage the risk of investment in a pension scheme by not having all your eggs in one basket and investing the money over the four main asset classes of cash, property, equities, in other words, shares, and bonds or government stocks or corporate bonds. So it's a spread of risk. And final salary pension schemes work in a similar way. Now, the benefit of the personal pension or money purchase pension is that the more money you pay in and the better the pension scheme performs, the higher the return. But there's nothing guaranteed about the money purchase pension scheme because it all depends on the performance of the underlying investments and how well you've managed that. When you get to retirement, you have the choice of a guaranteed income known as an annuity, which has got great parallels with final salary guaranteed pensions. They are in effect both one and the same, they're just given different names. Or you can leave the money invested, and the most popular choice is something known as income drawdown, where the money remains invested, but you can take an income from it, usually at a level that's sustainable. So in theory, you could deplete the whole value of your personal pension pot if it's badly managed, or you draw too much money out of it, or a combination of the two. In my experience, and I've been advising on pensions for over 30 years, I've never had a client who's depleted 100% a money purchase pension scheme, nor one has come anywhere near close. But that doesn't mean it couldn't happen. So private sector against public sector final salary pension schemes, what's the difference? Well, we're all familiar probably with public sector final salary pension schemes. By that I mean government schemes such as the local government pension scheme, various civil service pension schemes, the police, the teachers pension scheme. These schemes are known as gold plated. And the reason they're gold plated is because they're guaranteed by the government. And let's face it, governments don't go bust. You may argue that governments are really badly run and deserve to go bust, but they never go bust. Governments are always around. Whereas a private sector final salary pension scheme is funded mostly by businesses, and businesses can and do go out of business. So such schemes cannot possibly be described as gold plated. Now, George Osborne, the then Chancellor of the Exchequer, back in April 2015, introduced something known as pension freedoms. And from that date, money purchase pensions got a great boost. Money purchase pensions. Such scheme members are allowed to access as much of their pension fund as they wished once they reached age 55. Potentially, they could withdraw the whole pot, although they'd be taxed very heavily if they were to do so. Their pensions could be inherited by their spouses and then by their children and grandchildren and further down the line of descendants. But most important of all, the requirement to buy that annuity, that guaranteed income at age 75 was scrapped altogether. I felt that was a well overdue reform. Suddenly, these types of pensions, money purchase pensions, otherwise known as defined contribution schemes, became very attractive when compared to defined benefit or final salary pension schemes. So whilst defined benefit schemes do offer guaranteed pensions, they don't offer flexibility. Their pensions typically reduced by 50% on the first death. And on the second death, the pensions die with the spouse and or dependent. But dependents, if they're children, would only receive the pensions up to age 23 in most cases. So in other words, once the pensioner dies, if they do have a spouse, the pension reduces to 50%, and then when the spouse dies, the pension dies with them, leaving no benefits for future generations. The Pension Protection Fund. Now, this is a system or an organisation set up by the government, but believe it or not, it's not actually a government scheme. Most people are under the illusion it is if they're not aware of this scheme. In fact, the Pension Protection Fund is funded by levies on other final salary pension schemes, and by which I mean private sector final salary pension schemes. The problem with this is that this pool of schemes paying the levies to the PPF is shrinking year by year because more and more of them are getting absorbed by the Pension Protection Fund because they're failing. So the Pension Protection Fund is a scheme that's designed to protect the pensions of final salary pension scheme members when their employers become insolvent. So again, back to the point about gold-plated pensions, employers have to be private sector employers because public sector never becomes insolvent. The problem is people think that the Pension Protection Fund is guaranteed to rescue every single defined benefit pension scheme. That's not the case. The BHS pension scheme had a £700 million deficit when the company went bust. Now, the PPF wasn't going to rescue the scheme. They were umming and ahhing because it was such a huge deficit until political pressure forced Sir Philip Green to sell one of his £1 billion yachts, would you believe it, and pay £350 million into the BHS pension scheme to half its deficit from 700 to £350 million. Without this payment, the Pension Protection Fund would not have rescued the scheme. Now, if the PPF itself were to fail, it is doubtful the government would step in and rescue it, especially after the huge cost of bailing out the economy following the coronavirus pandemic. Also, the government has a poor track record of failing to bail out pensioners from defined benefit pension schemes. For those of you old enough who are watching this presentation, Robert Maxwell's raiding of the Mirror pension scheme some years ago is a case in point. So, what is the Pension Protection Fund? Well, it's a scheme that manages £32 billion of assets for its 249,000 members. Basically, if you're past retirement age, drawing your pension, or you've had to retire early due to ill health, and your company's pension scheme goes into the Pension Protection Fund, you'll still get 100% of your pension. The problem lies with people who have high pensions to come because the compensation level is capped, and for people who took their pension early before it went into the Pension Protection Fund, there's nowhere near as much protection for them. So, for example, let's say you're fortunate enough to be in a position where you could receive a very high pension of, say, £80,000 a year. But if it's absorbed by the Pension Protection Fund, the maximum cover you'll get is £41,461 at 65, but that's reduced to 90%, which is the maximum compensation limit. So your 80,000 pension falls to £37,315. That's hardly pension protection in my book. Also, as I said earlier, if you take your pension early and then it's taken over by the Pension Protection Fund, you could be in for a huge shock. There was a recent case that went to court by 25 pensioners who had retired early from various private sector pension schemes, and their schemes were then later taken over by the Pension Protection Fund. One example was of a man whose pension of £61,000 a year was reduced, wait for this, to £17,000 a year because he had retired at age 57, whereas those who retired at the normal retirement age of 65 got 100% of the pension. Now, these pensioners won their case because their case was based on age discrimination. They were successful, so the Pension Protection Fund is going to have to pay out more money in the future, which I feel reduces its effectiveness and will, by increasing its costs, will make it less able to look after as many schemes in the future. There is a 90% cap on benefits, as I mentioned earlier, but in reality, the average person loses 20% of their benefits. So although the cap's 90%, if you're below £41,461 pension, because the indexation is less generous than under most final salary pension schemes, the overall reduction in benefits is probably 20%. So you get about 80% for the average person, but not if you're a high pension. So final salary pension scheme deficits. I always like this word euphemism. It's funny how you get these pleasant sounding words for things that are actually quite unpleasant that come into the English language. And one of these words is pension scheme deficits. Let's be straight about this. If a pension scheme has liabilities, in other words, pensions, and doesn't have enough assets to pay it off, this can only be described as one thing. The pension scheme is insolvent. Let's be straight about this. If this were a public company, the company wouldn't survive. So many pension schemes, probably 2/3 in the UK, private sector pension schemes, are insolvent. Most companies have a plan to pay off their deficits over periods of up to 5 years, and even 10 years in some exceptional cases. Those who go insolvent get absorbed by the Pension Protection Fund if they're lucky. But the problem is that these deficits, on average, rise year after year after year. And I feel it's likely there's going to be more company failures and more pension scheme failures because of the coronavirus pandemic, because all the bad economic news is going to continue. More and more companies will go bust and more schemes will fail. So in theory, the Pension Protection Fund will bail out all of these defined benefit pension schemes. But in practice, it's unlikely to happen. So the Pension Protection Fund itself produces lots of statistics. I won't read every one on this page. Suffice to say that, as I said earlier, most schemes are in deficit. But what staggered me was that the total amount of deficits on the schemes that are in deficit as at June 2020, so right up to date, is £288 billion, down slightly from May 2020 at 290 billion. But that's only because the stock market rallied after the crash in February to March, and was still rallying between May and June. Year after year after year, the combined deficits and final salary pension schemes gets larger and larger and larger. And that's in spite of companies' plans to pay them off. So look at this, final salary pension scheme funding levels. As I said earlier, most schemes are about 2/3 funded. In other words, there's a shortfall of about 1/3 on the funding of most final salary pension schemes. This is an independent source, a company called XPS. Now, if you have a final salary pension scheme, if you want to transfer it, you have to take advice from a suitably qualified pensions advisor if the transfer value is above £30,000. The advice doesn't need to be to transfer. You've just got to have a certificate signed by that advisor that you've had advice. The problem is, in practice, pension companies don't want to accept a final salary pension transfer because of the stringent regulations if the advice by the advisor was to not transfer, although in theory they should accept the instruction from you as an individual. Now, in recent years, economic conditions have favoured final salary pension scheme transfers, or certainly transfers values, because they've risen a lot due to two main reasons. The yield on government stocks has fallen to a record low level, and defined benefit pension schemes have been offering higher transfer values to get rid of the liability on their employers' balance sheets. What do I mean by that? Well, where there is a deficit, that deficit, let's say, for example, was 20 million in public companies' pension scheme. That liability, that deficit, has to be shown on the company's own balance sheet, which is not obviously the same as the pension scheme. And so it shows as a liability, and public companies don't want liabilities on their balance sheets. So just to illustrate that, here's the yield on long-term gilts or government stocks falling over the years. It's carried on going down and it went down even further recently when base rates were dropped a few months ago from 0.75% to 0.1%. Yields in government stocks have now reached historic low levels. And the reason that's important is because the way a final salary pension transfer is calculated, it uses the yield on government stocks. So when the yield is lower, ironically, it pushes up the transfer values, even if stock markets have fallen in the meantime. As you can see here from this independent source, the same source, XPS, pension scheme transfer values have carried on rising. Although this is not absolutely up to date. They will have risen even further since this slide was brought out over the last 12 months. So what's a good transfer value? Again, I won't read every word, but there is something known as a multiple of the accrued pension to date. Now, what I mean by accrued pension is not the pension at date of leaving or the pension you're expecting to receive at retirement. There is, for people who need advice in this area, there's a figure in between those two dates, and that's the pension you've earned or accrued up to date. So let's say you left the scheme at age 55, the retirement age is 65, but you want to find out what the value is at age 60, then most pension schemes will give you the figure for the date of leaving, age 55. They'll give you the pension at retirement age 65, but most of them won't give you the amount of pension you'd get today if you were to take the pension at 60. So you need to know this magic figure, the accrued pension to date. Now I've used an example of £10,000 here and a transfer value of £400,000. So the way you work out the multiple is very simple. 400,000 divided by 10,000, it gives you a figure of 40 times. Believe you me, a transfer value of 40 times your accrued pension to date is fantastic. Bearing in mind that the average in the UK is 21.5 times. So what that means in effect is that the person with the 40 times multiple only needs to make an investment return of 2.5% a year net of charges in the personal pension to match the level of pension they receive from the final salary pension scheme. They might think, oh, well, it's just the same, but there's more risk in the personal pension. That's true, but when you think about it, the final salary pension scheme dies with you. So the £400,000 after you've died and your spouse, if you've got one, and many people don't have spouses when they die, then the whole £400,000 is lost forever to children and further descendants. Whereas if it's in a personal pension, the £400,000 carries on being inherited down the generations to children, grandchildren, great children, etc. And it's totally inheritance tax free forever. Now, if it's a very high transfer value, and so you only need to make very modest returns, and your family gets to keep all the money, your wife receives effectively 100% widow's pension if you're a husband who dies first. It's not officially known as a 100% widow's pension, but when you think about it, you step into your husband's shoes, you carry on receiving the income he was receiving. What is that other than 100% widow's pension? And also, if in the unfortunate event of the pensioner dying before age 75, the spouse and children and further descendants will receive the pension free of all taxes, not just inheritance tax. So quite staggering benefits. No wonder so many people want to transfer their final salary pensions into personal pensions. So if your transfer value, known as a CETV or cash equivalent transfer value, is a high one, in other words, more than 30, I would say, is pretty good, or upper 20s is pretty good. And it's suitable for you to consider a transfer based on a number of criteria, which I'll show you later, then you should at least consider having a defined benefit pension scheme reviewed by a qualified final salary pension specialist. That doesn't mean you should transfer it, at least get it reviewed. So recent events, we're all aware of the coronavirus pandemic. I don't know anyone who doesn't know it's happening. I mentioned earlier the reduction in base rates, which has caused an increase in transfer values. Also, if you transferred your pension a few months ago after the crash, you would have benefited from a very high transfer value, but also buying shares at cheap valuations because there's been a strong rally since then. So it's a double whammy, if you like, to use that phrase. If share prices fall again, and I'm predicting they will, although we don't know when, and you transfer with a high transfer value, then again you could benefit from both of these unique sets of circumstances. What will be the effects of COVID-19 and defined benefit pension schemes? My prediction is, as I said earlier, more companies will go bust and more schemes will fail. So the new FCA rules from 1st of October, again, I won't read everything here on the slide, other than just to summarise it for you. Basically, FCA, for whatever reason, seems to be politically opposed to final salary pension transfers. It's probably because the FCA itself, although people think it's an independent organisation, it's effectively a government quango. In other words, it is part of the government in all but name. It's run by the Treasury. The public sector has guaranteed pensions, and the FCA is no exception to this. There seems to be absolute bias against final salary pension transfers to the extent that if you as an advisor advise someone to transfer a final salary pension scheme into a personal pension, you're deemed to have given bad advice unless you can prove otherwise. Personally, I don't agree with this. I've had a number of cases where clients have been infinitely better off by transferring out of a final salary pension scheme into a personal pension, and I can prove it. Although having said that, I do accept that for the vast majority of people, they'd be better off staying in final salary pension schemes. But there's certainly many cases where you'd be better off not staying in the final salary pension scheme. But each case, in my opinion, should be judged on its merits. The FCA itself does accept that, for example, if you are terminally ill, then you're most certainly going to be better off transferring into a money purchase pension scheme. And that's because the death benefits of money purchase pension schemes are generally far higher than from a final salary pension scheme. And in fact, we did transfer such a case for a client, a dear client of ours who's now passed away a year before he died. And we're very, very popular with his surviving widow as a result. And he was delighted with us at the time of the transfer. I feel very strongly about this because what the FCA seems to have forgotten is that it's your pension, not theirs. I feel this is a case of nanny state interference. It doesn't seem to have occurred to the regulator that most individuals are sensible and that they have the human right to manage their own pensions as they see fit and in accordance with pension freedoms, and that most people are able to exercise judgment over the potential risk and reward of a transfer. In my experience, most people are cautious about their pensions in any case, and why wouldn't they be? So here's a nice little checklist. You don't need to read every line, but just basically, I love traffic light systems because it's so easy to follow, isn't it? So if your answer to the question is green, then it's more likely worth seeking advice on whether you should transfer or not. If it's yellow, maybe 50-50. If you come under the red category, then it probably isn't the right thing for you. Now I listed, would you believe it, 15 reasons why you should consider having your final salary pension at least reviewed, if not transferred. Now, just to pick on some of these points, I mentioned earlier, if you're terminally ill, that's point number 14, right near the bottom. For example, you might require a larger tax-free cash lump sum than you're being offered by your final salary pension scheme. As I mentioned earlier, you might want to leave far more of a pension to your wife if you're a husband who dies first, if the transfer value is a generous one, etc., etc. So each case needs to be judged on its merits, as I mentioned before. So what are public sector final salary pension transfers? Point to realise is that most public sector defined benefit pension schemes are unfunded. Would you believe it? What this means is that there's no money in the pot at all for the vast majority of public sector pension schemes. So if you're a nurse, a doctor, if you're a teacher, your pension is just a government promise. Those pensions are paid for out of the general pool of taxation. So all the taxation we all pay every year goes into a pot, it's spent every year, and that's the source of money for the vast majority of public sector pension schemes. It's quite staggering for most people to understand that. There's no money in the pot, unlike a money purchase pension scheme, which has real money in it. Now, transfers from government schemes, public sector schemes that are unfunded, were banned a few years ago because there's no money to transfer them. Now, there is a concept known as a Ponzi scheme. Now, this was basically based on an Italian fraudster many years ago, hence the word Ponzi. It's where you keep paying money in to a scheme and there's no money being built up, it's just spent. And the only money that comes back is from the money that gets paid in. Well, there's been many Ponzi schemes in history that have failed spectacularly, including many money schemes a few years ago that got banned by the FCA in the end. But in my opinion, the public sector pensions and state pensions are potentially nothing more than a Ponzi scheme. Because if there's no money there to pay them, you just purely rely on the government promise. Having said that, I'm not foolish. I do realise that the government, if you're in an unfunded public sector pension scheme, you're going to keep receiving your pensions. But my prediction is that those pensions will be downgraded year after year after year. It's already happening because the government realised there won't be enough money to pay these pensions because of what's known as the dependency factor. At the moment, there's 3 people working for every 1 retired. But by 2050, there'll be 1 person working for every 1 retired. Where is the taxation going to come from to pay such generous public sector and state pensions in the future? Highly unlikely. So there's going to be some reforms there. Now, there are some public sector defined benefit pension schemes which are funded, strangely enough. One's called the University Superannuation Scheme and the Local Government Pension Scheme, which is a huge scheme worth about £160 billion. So in theory, you could transfer out of these schemes, but I wouldn't recommend it. And the main reason is because the transfer values offered by these schemes are pretty lousy. I mentioned earlier this 21.5 times average, and that I've come across cases of as much as 49 times, which is an amazing transfer value. But we got a statement the other day for an existing client who's in the local government pension scheme, and the multiple, believe it or not, was less than 15. So very, very mean value. But because it's a government scheme, gold-plated, I'd advise someone to stay in that scheme anyway. There we are, gold-plated, public sector defined benefit pension schemes. So final salary pension scheme reviews. These can still be done up until 30th September. They still, in theory, can be carried out after 30th September. But the problem is that the FCA's stringent new rules is going to make it very difficult for most firms to be able to continue advising. And the main reason is because the FCA is taking away this concept known as contingent charging, by which the advisor would report on your final salary pension scheme, but not charge you unless you transfer the scheme, which to me seemed quite fair because it de-risks it for you as a pensioner. But they do have a point. It does mean that there's bias there for the firm advising. They're biased towards recommending a transfer. That's a fair thing to say. Having said that, most advisors I know, including ourselves, are not keen on advising on final salary pension transfers because of the tough stance by the FCA. So what we instead do, we refer to one of our panel of 3 specialists who are prepared to advise on final salary pensions under the existing rules, including contingent charging, at least up until 30th September. So if you do consider that you should have your pension at least reviewed, and one of these companies is prepared to do it without charge unless you transfer, then you've got very little to lose other than some time in having your pension reviewed. The reviews are very comprehensive. The reports can be extremely lengthy because the FCA require the advisor to cover such a lot of ground and to tick so many boxes. So it is quite a lot of work that has to be carried out by the pensions advisor, but it then puts you in a position to make an informed decision whether you should transfer or not, with very little to lose other than your time. The other reason we like referring to a third party is that that third party is unbiased, whether they recommend a transfer or not. So I've produced some sources of information, including our very own, very interesting, very enlightening 30-page guide to final salary pensions. Well, I would say that, wouldn't I? As I wrote it. But also, if you want other opinions, the FCA's website you could go to, the Consumers Association, which as the name implies, that is the publication, which is very much a consumers' rights champion. Or you might want to go to another website called unbiased.co.uk. So, are there any questions? Just give me a moment while we go back to the panel. First of all, before we go on to the questions, let me just take you through some important information disclaimers. Obviously, the value of investments can rise or fall. We might not get back the full amount invested. This isn't personalised advice. You do need to speak to a professional, so we can't be deemed to give you advice on this. So just bear with me. I'll find if there's any questions. Right, first question. How long does this process usually take? Would you help me fill out all the forms? Well, the whole process from starting to take the advice to actually the transfer can often take several months. You would have to take advice from the third-party specialists who would complete a questionnaire and assess your attitude to investment risk. We are not involved in the advice process, although we'd be quite happy to explain what things mean in the review report you get from that third-party advisor. There's another question. I can imagine there's a lot to complete. Not too bad. I mean, the usual fact-find questionnaire, your assets, liabilities, income, expenditure, and also your attitude to investment risk. In my experience, people can complete those forms in half an hour, maybe an hour maximum. There are a few other forms to complete, but it's worth it to get the review, I would say, if you feel that you could benefit from this. Another question is, also, is it often that transfer is not recommended? For what reason is this usually? That's a good question, actually, because basically you have to use this process called triage, which means that you assess whether a final salary pension is of merit to even have it reviewed. So I would only refer a client to a third party if there were a lot of good positive reasons why it should be reviewed, including, for example, high transfer value, maybe married with children, medium to high risk investor, etc., etc. So they met the criteria. It'd be worth at least having it reviewed. That doesn't mean it should be reviewed or could result in a transfer. We have had cases where it's been declined, but I can't say what the percentage is to go ahead or be declined, because you remember, I'm only passing cases on to the third party where it's already a high transfer value and the client is already in favour and they meet a lot of criteria why it should be transferred. If I was just to refer everybody to them, I think the vast, probably the majority would be declined. Next question is, what's your fee schedule? If I'm able to transfer my defined benefit pension into a SAS, which is a small self-administered pension scheme. I don't like to sit on the fence on this one, but you will be given full information on what the charges would be before you'd be asked to proceed. So you've got nothing to lose. But in my experience, the maximum any client of ours would normally have to pay would be 3% of the transfer value. But that, let me explain why that is. That would be based on a relatively low transfer value. It's normally not worth even considering it with a figure below £100,000. But on the higher transfer value, say £1 million, you're probably looking at a total fee of 1%. This is called the implementation fee. And this is deducted from the value of your pension when it's transferred. So that's all the questions I've got so far. I'm sorry we've overrun 10 minutes. I must have been too keen today. But I thank you for your time, and I hope you found it very useful. You'll be getting the slides after the presentation, as I mentioned earlier. If there's any questions burning questions you've still got, feel free to ask us after the event. If there's any that I haven't been informed of yet, we'll follow up after the event, probably by email. You get the chance to give feedback on this presentation from GoToWebinar, the company we've used to present the seminar today. And last but not least, take care, keep safe, and stay healthy.